Highly leveraged transactions, leveraged buyout valuation, and modeling basics. How are leveraged buyouts valued? This video addresses the basics of valuing and modeling highly leveraged transactions. Transactions involving large amounts of debt to finance the purchase price generally are described as LBOs. In an LBO, borrowed funds, often secured by assets of the target firm, are used to pay for most of the purchase price, with the remainder provided by a financial sponsor, such as a private equity investor group or hedge fund. LBOs can be of an entire company or divisions of a company. LBO targets can be private or public firms. The terms buyout firm and financial sponsor are used interchangeably throughout this chapter to include the variety of investor groups, such as private equity investors and hedge funds, that commonly engage in LBO transactions. The cost of capital, CC, and adjusted present value, APV, methods are described in detail along with the strengths and weaknesses of each approach. The video also addresses how investors may evaluate LBO investment opportunities and illustrates a basic format for an LBO financial model. Such models may be used to determine the maximum amount of leverage that can be supported by the target firm consistent with the investor's desired financial returns. An LBO can be valued from the perspective of common equity investors only or all those who supply funds, including common and preferred investors and lenders. Conventional capital budgeting procedures may be used to evaluate the LBO. The transaction makes sense from the viewpoint of all investors if the present value of the cash flows to the firm or enterprise value, discounted at the weighted average cost of capital, WACC, equals or exceeds the total investment consisting of debt, common equity, and preferred equity required to buy the outstanding shares of the target company. The equation in this slide implies that the target firm can earn its cost of capital and return sufficient cash flow to all investors and lenders, enabling them to meet or exceed their required returns. However, it is possible for an LBO to make sense to common equity investors but not to other investors, such as pre-LBO debt holders and preferred stockholders. What follows is a discussion of two methods for valuing LBOs. The cost of capital or CC method adjusts future cash flows for changes in the cost of capital as the firm reduces its outstanding debt. The second method, adjusted present value, APV, sums the value of the firm without debt plus the value of future tax savings resulting from the tax deductibility of interest. The cost of capital method, if the debt-to-equity (DE) ratio is expected to be constant, discounting future cash flows with a constant WACC is appropriate. However, assuming a constant DE ratio for highly leveraged deals is inconsistent with actual practice. Many firms reduce their outstanding debt relative to equity, and such changes in the capital structure distort valuation estimates based on traditional discounted cash flow (DCF) methods. The high leverage associated with LBOs increases the riskiness of cash flows available to equity investors because of the increase in fixed obligations to lenders. The cost of equity, CO, should be adjusted for the increased leverage of the firm. Because the debt is to be paid off over time, the CO will decrease. Therefore, in valuing an LBO, the analyst must project free cash flows and adjust the discount rate to reflect changes in the capital structure. Instead of discounting the cash flows at a constant discount rate, the discount rate must decline with the firm's declining DE ratio. A four-step methodology for adjusting the discount rate to reflect a firm's declining leverage is discussed next. Step 1. Project annual cash flows until the target debt-to-equity ratio is achieved. Step 1 involves projecting free cash flow to equity, FCFE, annually until the LBO reaches its target DE ratio. The target DE ratio often is the industry average ratio or one that would appear acceptable to strategic buyers or IPO investors or the point at which the firm resumes paying taxes. Step 2. Project debt-to-equity ratios. The decline in DE ratios depends on known debt repayment schedules and the projected growth in the market value of shareholders' equity. The latter can be assumed to grow in line with the anticipated growth in net income. Step 3. Adjust the discount rate to reflect changing risk. The high leverage associated with an LBO increases the risk of the cash flows available for equity investors. As the LBO's high debt level is reduced, the CO needs to be adjusted to reflect declining risk as measured by the firm's levered beta. Because the firm's CO changes over time, the firm's cumulative CO is used to discount projected cash flows. This reflects the fact that each period's cash flows generate a different rate of return. Step 4. Determine if the deal makes sense. Making sense of the deal requires calculating the present value, PV, of FCFE discounted by the cumulative co, including the terminal value. Calculate the terminal value of equity, TVE, and of the firm in year T. TVE represents the PV of the dollar proceeds available to the firm at time T, generated by selling equity to the public. To a strategic buyer or another LBO firm, a similar calculation would be made for the terminal value of the firm using the appropriate weighted average cost of capital for the terminal period, which would then be converted to a present value and added to the PV of free cash flows to the firm. The deal makes sense to common equity investors if the total PV exceeds the value of the equity investment in the deal, and to lenders and preferred equity investors if the total PV of free cash flow to the firm, FCFF, is greater than the total cost of the deal. Adjusted present value method. Some analysts suggest that the bias from a variable discount rate is avoidable by separating the value of a firm's operations into two components: the firm's value as if it were debt-free and the value of interest tax savings or tax shield. The total value of the firm is the PV of the firm's free cash flows to equity investors, i.e., unlevered cash flows, plus the PV of future tax savings discounted at the firm's unlevered co. The unlevered co is the appropriate discount rate rather than the cost of debt or a risk-free rate, because tax savings are subject to risk as the firm may be unable to use the tax savings due to continuing operating losses. The justification for the APV method reflects the theory that firm value is unaffected by the way in which it is financed. However, studies suggest that for LBOs, the availability and cost of financing does indeed impact financing and investment decisions. In the presence of taxes, firms may be less leveraged than they should be. Given the potentially large tax benefits associated with debt, firms can increase market value by increasing leverage to the point at which the additional contribution of the tax shield to the firm's market value begins to decline. However, management's decision to increase leverage affects and is affected by the firm's credit rating. Consequently, the tax benefits of higher leverage may be partially or entirely offset by the higher probability of default because of an increase in leverage. For the APV method to be applicable in highly leveraged transactions, the analyst needs to introduce the cost of financial distress, FD. In general, leverage is higher when the cost of financial distress is lower. The direct cost of financial distress includes the costs associated with reorganization in bankruptcy and ultimately liquidation. Direct costs include legal and accounting fees. Financial distress can also have an indirect cost even on firms that are able to avoid bankruptcy or liquidation. Consequently, in applying the APV method, the PV of a highly leveraged transaction, PVHL, would reflect the firm's PV without leverage, PVUL, plus the PV of tax savings less the PV of expected FD, PVFD. Step 1. Estimate the present value of the target firm's unlevered cash flows for the period during which the debt-to-total capital ratio is changing. The analyst should project free cash flows to equity, for example, unlevered cash flows. During the firm's terminal period, the debt-to-total capital structure is assumed to be stable and the free cash flows are projected to grow at a constant rate. Estimate the unlevered co for discounting cash flows during the period when the capital structure is changing and the WACC for discounting during the terminal period. The WACC is estimated using the proportions of debt and equity that make up the firm's capital structure in the final year of the period when the capital structure is changing. Step 2. Estimate the present value of anticipated tax savings project, the annual tax savings resulting from the tax deductibility of interest. Discount projected tax savings at the firm's unlevered co because it reflects a higher level of risk than either the WACC or after-tax cost of debt. Tax savings are subject to risk comparable to the firm's cash flows in that a highly leveraged firm may default or the tax savings go unused. Step 3. Estimate the potential cost of financial distress. The magnitude of the cost of financial distress can range from 10% to 30% of a firm's pre-distressed market value. The probability of financial distress can be estimated by analyzing bond ratings 17 and the cumulative probabilities of default for bonds in different ratings classes over 5 and 10-year periods. Step 4. Determine if the deal makes sense. The total value of the firm is the sum of the PV of the firm's cash flows to equity, interest tax savings, and terminal value discounted at the firm's unlevered co less the anticipated cost of FD. Note that the terminal value is calculated using WACC, but that it is discounted to the present using the unlevered CO because it represents the present value of cash flows in the final year of the period when the firm's capital structure is changing and beyond. For the deal to make sense, the PV less the value of equity invested in the transaction, net present value, must be greater than or equal to 0. Comparing the cost of capital and adjusted present value methods, the cost of capital method adjusts future cash flows for changes in the cost of capital as the firm reduces its outstanding debt. The second method, APV, sums the value of the firm without debt plus the value of tax savings resulting from the tax deductibility of interest. The cost of capital approach has the advantage of specifically attempting to adjust the discount rate for changes in risk, but it is more cumbersome to calculate than the APV scheme. Although the APV method is relatively simple to calculate, it relies on highly problematic assumptions. It ignores the impact of leverage on the discount rate as debt is repaid, implying that adding debt will always increase firm value by increasing the tax shield. Incorporating the effects of leverage into the APV method requires the estimation of the cost and probability of FD for highly leveraged firms, often a highly subjective undertaking. Finally, it is unclear whether the true discount rate that should be used for the APV approach is the cost of debt, unlevered cost of equity, or somewhere between the two. Thank you for listening.